Remember, money market instruments are for a short-term period of time, which is for less than a year. RBI is one regulatory apex body which usually take care of all kind of money market instruments. Capital market is going to consist of three types of combination, that is shares, bonds and debentures. Hello students, I welcome you to the Financial Market and Services subject. So in today's session, we are going to continue from the previous session. So that is Unit 2. So in Unit 2, we are going to learn about different financial institutions. So and what are the different objectives, functions of it. And before that, I'm also going to talk about the important financial markets that we have got. So that is two types of market, money market and capital market. So before I move on to the detailed session, so let me give my introduction. So I'm Vaishnavi, Faculty of Commerce from Vidhyaashram First Grade College, Temple of Excellence, MYSURU. So we'll move on to the agenda. So today's agenda is about money market. So as I've told, so in a financial market, so there are two types of markets. So one is money market and another one is capital market. So we'll see the introduction of money market and institutions of money market. So who are the persons who usually issue the money market instruments. So and then next we're going to learn about what are the instruments of the money market. Next we're going to learn about what is capital market and what are the instruments of capital market. So these are important topics for your examination point of view. So I request to have a please keen observation regarding the concepts that I'm going to cover today. So this is the agenda. We'll move on to the first topic, money market. So financial services, like as I've told, so it is about like the easy flow of money. So transactions that usually takes place in the market or any kind of exchange of funds. So you need a regulatory body or you need a proper division of what kind of instruments that you're going to deal with. Okay, so under that, so first is about a money market. So money market is all about, the money market is a market for the short-term instruments that are close substitute to the money. Okay, so like why it has been divided, because so not everyone are been ready to invest for a longer period of time, right? So some people might need instant returns or faster returns. So for such kind of people, money market is a good opportunity for them to invest in different kind of investment opportunities that has been given by the government. So money market is all about short term investments which is equivalent to less than 365 days. Okay, so the short-term instruments are highly liquid, easily marketable with little change of losses. So there is a risk involved in such kind of money market, but it has been highly liquidable and easy to investment and easy to have a proper analysis about different instruments that are there in the market. So it provides for the quick and dependent transfer of short-term debt instruments maturing in 1 year or less than a year, which are used for financial needs of consumers, businesses, agriculture and the government. So sometimes what happens, the corporate, the companies or government or any kind of financial institution might be needing of some money, but not for a longer time purpose. It is for a longer period of time. So during that time, so this kind of instruments comes in a handy for these kind of institutions like banks or any government or any kind of a corporate companies that usually issue the money to the investors. Okay, so remember, money market instruments are for a short-term period of time, which is for less than a year. So this is a basic introduction of it. So next we will see about who are all the institutions that usually deal with the money market. So first is central bank. So central bank of the country. So in our country we have got a central bank or RBI. So usually RBI is the one that usually issues the money market instruments into the market. So the country is the pivotal around which the entire money market revolves. It acts as a guardian of the money market and increases or decreases the supply of money and credit in the interest of stability of the economy. So as I have told, so RBI is one regulatory apex body which usually take care of all kind of money market instruments, and it also try to analyze the increase or decrease of the prices in a particular market. So it does not itself enter into direct transactions, but controls the money market through variations in the bank rate and open market operation. So it might not directly deal with the people in the money market, but it usually act like an intermediary body between the government as well as the banks. So usually what will happen, so a money market has been issued by RBI. So one more is banking, so except regional rural banks, then non-banking financial institutions, any top corporate officials or top corporate companies, and individuals. Okay, so these are the 5 types of people, or 5 ways where you can invest in the money market. Okay, so usually what happens if the government is in needed of money. Okay, so if the government is in need of money, which is for a lesser period of time, so government will give the securities to the RBI, and now the RBI will be giving that securities to the banks, and in return banks is going to provide some money to the RBI. So unlike that, it's a kind of a process, it's a kind of a chain. So these kind of instruments will be coming under the money market instruments. Okay, so RBI is one such a kind of a body or an apex body that act like an intermediate between the lender and the borrower. So next is about the commercial bank. So as I've told, so one more institution that provides that deals with the money market is commercial banks. All kind of commercial banks except the regional rural banks will deal with the money market in India. So next type of institution is non-banking financial institutions or intermediaries. So non-banking financial institutions which are involving in term deposits or premium deposits like that, like for example LIC, Provident Fund, or any Aditya Birla Capital. So all these comes under the non-banking financial institutions. Any institution which is not related to the banking services, all those comes under the non-banking financial institution. So this is also one of the institution or an instrument that provides you the money market to the people. So next is about discount houses and bill brokers. So it is in a developed money market, that is in developed countries. So private companies operate discount houses. So as I have told, any top corporate officials or top corporate companies are going to have their separate houses called discount houses. The primary function of discount houses is to discount the bill on behalf of the other. They in return form the commercial banks and acceptance houses. So what happens here is like, so they usually issues the money market instruments to the people or an individual who are ready to invest into that particular kind of an instrument for a lesser period of time, that too for a discounted price, and later on they are going to pay them back with a face value of the market. So that's the basic operation of the discount houses. So next type is about acceptance houses. So it is an institution houses developed from the bankers who transferred their headquarters to the London money market in the 19th century and in the earlier 20th century. So this is like early in the 20th century, usually any kind of an institution that are being tied up with the London market, so they are going to issue those. So they act like an agents between exporters and importers and between the lender and the borrower trade. So basically these kind of acceptance houses so are mainly involved in the export and import of the products in a particular country. So they accept the bills drawn on merchants whose financial standing is not known in order to make bills negotiable in the London money market. So this is about like this concept of bills of exchange. So I'll talk about it in the coming slides. Okay, so it is about like there is a contract in between the lender and the borrower where the borrower needs to get a amount from the lender. So instead of that, they can directly go to the bank and they can avail the loan for a period of time. So that's the basic concept of it. So let me explain it in detail in the bills of exchange concept. So this is about the acceptance houses. So next we are going to learn about the instruments of money market. So this is an important concept for you. You might also expect a question on the instruments on money market. So we'll see first is about the promissory note. Okay, the name itself you can understand that it is about a promise. Okay, so it's a contract between two business people where the lender is going to take the money from the borrower and it is a contract between them, and they are going to have a written agreement, written promise, and on the part of the businessman or a business company, and at a certain sum of money, and agree to the future date. Okay, so at a future date, so it is a promise between the two people that they are going to give back the money to the lender who have lent the money to the borrower, and depending on the maturity value and depending on the interest, rate of interest, it's a contract between them, and a legal document is been there between both of them. So such will be called as a promissory note. So promissory notes is usually issued for a payment of 90 days with a grace period of 3 days. Next is bills of exchange or commercial bills. So as I've told, so bills of exchange is an kind of an easy concept or an important concept that many kind of a businessmen they are usually using for generating an income inside their businesses. So I'll give an example here. So let's take an example like we have two companies, say for example ABC and XYZ. So we have got two types of company here. Now ABC is a small company that usually lends raw materials to XYZ company. Okay. Now XYZ company needs to pay some amount to the ABC company. So because ABC have given some raw materials to them. So what XYZ company will tell is like, I'll give you the money after 2 months. So now what will happen? So now ABC does not have money in their hands now, and they are going to get the money after 2 months. So but ABC needs some urgent funds for the daily operation or for some other reason. So now what will happen is like ABC will go to the bank and they request that, so I am supposed to get so and so money from XYZ company. So please give me some amount on behalf of the XYZ. Okay, this is the concept of bills of exchange. So what happens here? So bank will take the details from the ABC. So they usually come to a contract. So there is a legal contract between ABC and XYZ. Both of them will be coming into the contract and they'll sign in a legal document, and that legal document will be submitted to the bank, and now bank will be giving some money to the ABC company, and now XYZ needs to pay the money to bank. So this is the concept of bills of exchange. So the bills of exchange is another instrument where the money market, the bill of exchange, which is similar to the promissory note, except in that it is drawn by the creditor and is accepted by the bank of a debtor. So as I've told, it has been drawn by the creditor and it has been accepted by the banker. This is a concept of bills of exchange. Next is treasury bills. So treasury bills is also one of the important type of a money market instrument that has been issued by the government. So it is a money market issued by the treasury bill, which is issued by the varying periods of less than 1 year. They are issued by the secretary to the treasury in England and are payable at the Bank of England. So in India, the treasury bills are issued by the government of India at a discounted generally between 91 days and 364 days. There are three types of treasury bills in India, that is 91 days, 182 days and 364 days. So treasury bills is also like a concept. Say for example, if the government is in need of some money. So government is in need of money. So government is going to sell the securities to RBI or to the apex body in that particular country. Now what RBI is going to do is like they are going to sell the securities to the bank, that is commercial bank and non-banking financial institutions or non-banking financial companies. So now after they have got the securities from the government and they're going to sell it to the commercial banks and non-banking financial institution. Now the commercial banks are going to give back the money to RBI. So they are going to sell it with a discounted rate. So based on the what is the face value of it. So now here, as they have sold the securities to the bank, that is the commercial bank, to the non-banking financial institutions. So at a discounted rate, say for example, RBI need 1 lakh rupees. But it is going to sell the securities to the commercial banks and non-banking financial institution for 90,000 rupees at a discount of 10,000. So later, after the maturity, that is within a 364 days or 90 days based upon the agreement. So they are going to give back they are going to get back the money with the face value of 1 lakh rupees. So the profit here is what? 10,000 rupees to the commercial banks or the non-banking financial institution. So this concept is called as a treasury bills or government securities, you can call it. So next is call and notice money. Call and notice money is also for a lesser period of time. So what usually happens is like, So first we'll talk about the call money. So sometimes what happens, bank also will be need of some money, right? So as banks takes the deposits from the customers, but sometimes banks also might be in need of money. So what will happen? So bank will call for another bank to help for some, to lend some money. Okay, so this concept will be called as call money. So this concept will be called as a call money. Okay, whereas the notice money is what? So if it is for one day, it is called call money. If it is for more than one day, that is for 2 days to 14 days, it is called notice money. Understood? So usually what happens here, so bank will be in need of some money. So bank will call to another bank regarding the lending of some money. So regarding the money. So what will happen here is like, so bank will give the money to another bank. So if it is for only one day, that will be called as call money. If it is for more than 2 days to 14 days, will be called as a notice money. So this concept is called call money and notice money. And if it's for more than 14 days, that is called term deposits. Okay. So this is the one of the instrument. Next is about interbank term market. So this market is exclusive for commercial and cooperative banks in India, which borrow and lend funds for a period of over 14 days or up to 90 days without any collateral security at a market at a determined rates. So as I've told, it is also similar to the call money and money market. So here it is for a period of 14 days or more than 14 days up to the 90 days. So there where a bank will be going to lend some money to another bank without any form of a security. So next is about certificate of deposits. So this is also one of the important type of a money market instrument. So it is issued by the commercial banks at a discounted on face value. So the discount rate is determined by the market in India. Minimum size of the issue is rupees 25 lakhs with the minimum subscription of rupees 5 lakh. The maturity period is between 3 months and 12 months. So certificate of deposits like your savings deposit or recurring deposit or any fixed deposit. So all those comes under the certificate of deposits in the money market. So next is about commercial papers. So commercial papers is also one of the important type of a money market instrument. It has been issued by the highly rated companies. So as I've told, commercial papers are also been issued by the top rated companies to raise a short-term working capital requirements directly from the market instead of borrowing from the banks. Okay, so it is for a shorter period of time instead of borrowing some loan from the banks. So the top rated financial companies or top rated companies usually call for such kind of source of finance is called as a commercial paper. So commercial paper is a promise by the borrowing company to repay the loan at a specified date, normally for a period of 3 months to 6 months. Okay, this is usually most popular in countries like Japan, Australia, and in India it has gotten popularity from the 1990. This is about the commercial papers. So next we will talk about the capital market. So money market is all about small market or short-term market which is for a less than 1 year. So capital market is again to the opposite to the money market. So capital market it is usually contains the shares, bonds and debtors or debt will be combination of all these three for a longer period of time. It is called capital market. The primary role of this market is to make an investment from the investors who have surplus funds to the ones who are running in deficit. So capital market is a place where different financial instruments are traded between the different entities. Capital market are used to sell equities, that is stocks and debt securities. So as I have told, capital market is a combination of stock, bonds and debt securities. So wherein it is for a longer period of time. So it is about the basic introduction about the capital market. So next we will see what is the capital market structure. So it is having two types of market. One is primary market and secondary market. So under the primary market, it consists of company that issues securities to the investors who purchase those securities directly from issuing company through an IPO. Okay, that is initial public offering. When the company goes to the public, it sells its stocks and bonds to the large institutional investors like hedge funds and mutual funds. So sometimes what will happen, so if a company needs to get a registered, or if a company needs to get a high level of income or high level of finance to their companies, they usually go for IPOs to the larger financial institutions like any arbitrage institutions or any hedge funds or any mutual funds. So they usually having the fresh issue of the stocks or shares or debt instruments to the company. So that will be called as the primary market. So next is secondary market. It is a place where the trade of already issued certificates is between the investors are overseen by the regulatory body. So that means like it has already been issued by the company to the public or to the any kind of investors. So then later they are going to sell it and they are going to again repurchase by the other investors. So that is called as a secondary market. So next we will talk about the instruments of capital market. So as I have told, capital market is going to consist of three types of combination, that is shares, bonds and debentures. So we'll talk about a share. So what do you mean by a share? So a share is a indivisible or divisible kind of a property or divisible kind of a capital from a company which has been equally divided based upon the finance or based upon the amount that they are going to raise for the company. So that is called a share. So the ownership capital of a company is divided into several indivisible units of a fixed amount. Okay. So as I've told, it is about equally divided based upon the source of or based upon the total amount that you're going to need it from the investors. So this is about the share. So under that we have got three types of shares: equity shares, preference shares and sweat equity shares. So under that, first is equity shares. So you know that equity shares are a kind of a ownership shares that has been usually issued by the company to the investors. So next is preference shares. So this is secondary type of a market where the preference shares or a preference will be given to the preference shareholders first, then later it will be given to the equity shareholders. So it is the name suggests such holders shares enjoy exclusive right or preferential treatment by that company in specific aspects. Okay, so that means like they are going to have a preferential dividend share, preferential voting shares, etc. in a company board meeting or in a annual general meeting. So next is about sweat equity shares. This is also another type of an equity shares where it has been specially issued to the company employees. Okay, so if there are any kind of an employees who are been working in the company for a longer period of time, so based on their credibility, so they are going to issue some amount to the to the employees of the company. So it is called sweat equity shares. So these are the three types of shares we have got. So next is debt security. So it is a kind of a fixed income instrument primarily issued by the sovereign and state government and municipalities and even the companies to finance the infrastructural development and other types of projects. So debt securities or debt instruments, under that the famous kind is called debentures. So debentures is one of the important debt security wherein for a longer period of time they are going to get the money, especially for any kind of infrastructural developments or any big projects that are going to invest in the company. That is called debt securities. Next is bonds. So bonds are also another important type of instrument. So the bond holders are considered as creditors. Considering such an entity are entitled to periodic interest payments. So this is for a longer period of time and with a periodic interest payments. So furthermore, bonds carry a fixed lock-in period. So for a fixed period of time, they are going to get the interest till the maturity period. Therefore, issues of bonds are mandated to repay the principal amount on the maturity date to the bond holders. So it is also kind of a contract between the issuer and the borrower. Okay, so where they are going to pay a specified amount of interest to their bond holders for a specific period of time. After the maturity period, they are going to get the principal amount back to their account. So this is called bonds. Types of bonds we have got government bonds, municipal bonds, institution bonds and corporate bonds. This is about the bonds. Next is debentures. So this is also one of the important type of an instrument which is already having an unsecured investment options. So consequently, they are not backed by any kind of an asset or collateral. So debentures are kind of a debt instrument where they are being invested for a longer period of time, but least preferences will be given for the debenture holders. So this is about the debentures. Next is derivative instruments. This is an important concept. So under derivative instruments, so we have got 4 types of it. So first is forwards, futures, options and swaps. So we'll see one by one. So forward contract. Okay. So it's a contract between 2 people, wherein the customized contract between 2 people where settlement takes place on a specified date in a future at today's pre-agreed price. Okay. So I'll give a small example here. So person A is there and person B is there. Okay, so person A is going to sell some goods to person B at a predetermined price at a future date. Okay, so person A, say for example, is going to sell some gold to person B at a predetermined price to person B at a future date. Okay, so this is a contract called forward. So the difference here is like the forward and futures, both of them are same kind of a concept, but here usually what happens is like, so the forward contracts usually takes place under the concept called OTC. So now what is OTC? OTC is about over the trade concept or over the counter concept. Okay, so over the counter means like it's a direct kind of an interaction or direct kind of an exchange of goods from one person to another person. There is no involvement of middlemen or there is no involvement of any market related thing. So that's the forward concept. Now what is a future one? So future is also the same concept. So future is simple one. So here again I'll take some A person and again B person. So A is selling some kind of any kind of an asset. We'll take an example of like wheat. So he's going to sell some wheat bags to person B at a predetermined price and a predetermined date. Okay, that is called futures. Okay, so we'll talk about the next topic called options. So under that you can understand the name itself is option. So wherein here the option will be holding on the hands of a buyer regarding the buying or selling of a asset. Okay, so you can sell any kind of an underlying asset like stocks, bonds or shares or any kind of an instruments that are been having the money worth. Okay, so the option here, contract or instrument that give the holder the instrument to right to buy or sell the underlying asset at a predetermined price. Okay, the buyer is going to have the right whether to sell or purchase the product at a predetermined price. Now the options are having 2 types. One is call option and one more is put option. Okay, under the call option, so what happens is like the buyer has the right but not obligated to buy a given quantity of an underlying asset at a given price on or before a given future date. So I'll simplify it. So under the call option here, the buyer is going to have the right but not compulsorily to buy an underlying asset at a predetermined price at a predetermined date. Okay, that is called call option. In case of put option, here the buyer is having the right but not obligated to sell the underlying asset at a predetermined price on a predetermined date. Okay, so in case of call option, the buyer is going to have the right but not compulsorily to buy the product or buy the underlying asset at a predetermined date, time or price. Okay, that is called call option. This is the put option. Here the buyer is going to have the right but not compulsorily to sell the underlying asset to another person regarding the price, time and date of the contract. So this is about the options. I hope you have understood it. So next is swaps. So swaps is also another important type of a concept. So the name itself is, you can understand, swapping, that is called exchanging of the goods. Okay, so we have got 2 types of swaps. One is interest swaps and currency swaps. So in case of interest swaps, what happens is like, so 2 persons will be there. So one person will be having the fixed interest and another person is having the variable interest. So now based upon the market, now the people can come together and they can swap their interest or vice versa. Okay, that is called interest. Currency swaps, you can understand, exchanging of the currencies between the two people. This is about the swaps. So these are the main important instruments of capital market. So under the next session, we are going to learn about the objectives and functions of these banks are there for in your syllabus. Objectives and functions of Industrial Financial Corporation of India, Industrial Development Bank of India, State Financial Corporations, Industrial Credit and Investment Bank Corporation of India, that is ICICI Bank. Next is Exim Bank of India, then National Small Industrial Development Corporation and National Industrial Development Corporation. So these are some kind of important financial institutions are there in India. We are going to understand what are their objectives and functions of each and every bank in the next session. So I hope so you have understood today's session. So we have talked about important financial markets, that is called capital market and money market. So capital market is for the longer time purpose, whereas money market is for the short term purposes. So you can understand the difference between them. So I hope you have understood today's session. So in the coming session, I'll talk about these kind of topics. So I'll meet you in the next class. Thank you so much.